Hey everybody, Larry Berman here, and here's what's on my radar this week. I've got my yellow shirt on for a reason, and the reason is caution. And I've been talking for quite a while now about, just be careful. We're in a bear market. You've got all these longer term negative factors that are at play and looking for anything but short covering and temporary rallies is probably not what you want to do. There will come a point in time when we get to a pivot. That's, in my mind, not going to be until maybe first quarter, second quarter of next year at this point. So let's have a look at some of the charts and see what they're telling us. So first chart we want to look at is the U.S. long bond in terms of yield. And what we saw this past week is a retest of the extreme yields that we saw in June that started to really stress asset markets. Of course, we saw the counter trend rally from the June lows into July, but we retested those levels. Initially, we've held. But if we zoom in a little bit here, you can clearly see on the yield chart that while we held, we tested, we got slightly through, there's been no meaningful desire to move, against this. And so, why is the long end of the curve, doing this? Because we go back in time, and we have to go pretty far back in time here to actually see when yields were significantly higher. You can see on this chart, we're already back into 2014 before we see yields, higher than 3.5% in the 30-year. And they briefly touched 4% in 2013 when the world was just on fire. We were recovering from the great financial crisis, and, we were worried. Remember taper tantrum? So that was 2013. For the long end to take the next notch up to 4%, this is going to have everything to do with how the Fed's going to be unwinding their balance sheet. We do know, starting this month, that we are going to see an accelerated push to wind down the balance sheet, $95 billion a month. This is going to be a big challenge for risk assets. And so while the world hasn't fallen apart today, it largely hasn't fallen apart because earnings expectations actually still are okay. We have not seen a material downgrade to forward-looking earnings yet. And that just takes time to get through. Remember, analysts are always and forever behind the curve. Strategists too, generally speaking, that come from the big bulge bracket firms. Very few people on the street are willing to put out their neck on a really far out of consensus call, but make no mistake, there are some. The other reason things are contained is this guy right here. This is the 2-year forward inflation swap on the US zero curve. And what it's telling us in recent weeks is that inflation expectations are coming down. So that has everything to do with how aggressive the Fed is going to need to be and how long they're going to have to be higher for longer. So right now, based on their persistent hawkishness, we saw a couple of Fed members come out this week saying we're in the 75 camp. So they're prepping the market for a 75er on September 21st. And so far, asset markets have bounced. But this is not the end. This is not a pivot. This is not anything at all related to risk on being bullish. Counter trend, oversold rally at best. When we look at the economic calendar this week, obviously CPI, PPI, inflation numbers. And what we're seeing here is that, month over month, a bit of a downtick. Year over year, down off the 8.5. It was over 9. It's now going to come down to 8. But have a look at the core. The core is actually expected to tick up. And that's the persistent inflation. So when we look at wages and wage pressures and those things, we are seeing those numbers come off the boil a little bit, but still really, really elevated. And so if we get through the inflation numbers this week and the market still has a good bid to it, maybe we got to rethink things, but I don't think so. On the other side of the inflation is the growth. So what's happening? Well, we also see this week retail sales. So we got Tuesday CPI, Wednesday PPI, Thursday retail sales, Friday my youngest daughter's birthday. Markets won't care too much about that, but Daddy sure does. Okay, so retail sales. Well, headline number 0. So that's bad, but really it's ex-auto and gas still 0.8. So it's gas prices coming down, which is a huge part of retail sales, mind you, that is taking the edge off. When you look at the number, remember these are nominal numbers. Inflation's running at 8. Retail sales 0.8 for the month, core. Inflation running at 8. You do the math on that, and volume sales are flat or in decline. So you're seeing nominal numbers higher, the dollar spending, but after inflation, there's no volume, extra volume. So that is the growth side. And so that growth side now is starting to get under pressure. And what we haven't seen pressure on yet is the employment side. So the initial claims, they came down again this week. We're seeing strong labor. It's going to be persistent on wages. The Fed has got a tough balancing act, folks, for the next 2 quarters minimum. And so risk on rally, sure, but is this the breakout? Absolutely not. Let's have a look at our bull and bear pick of the week. So we talked about interest rates and the importance of that 350 level on long bonds, and there's a trade here. TLT is the ETF that trades the 20-plus year part of the curve, 30-year duration, 30-year bonds, 20-year bonds. We saw that important yield level. We can see it in the charts here going back to 2014. You can blow this up. So for the aggressive traders out there, we can look for a little bit of this being your best recession hedge at the moment. I get that yields are going to be stressed. You want to buy into it at this point. We started nibbling on our bond portfolio. You might remember a few weeks ago, we said we were cutting duration and selling our TLT out up here. This week, we started buying it back, and we're looking to add to that position for an inflation hedge in our balanced portfolios where we can and want to own fixed income. Again, I don't like the asset class overall, but where you have to do it, now is the opportunity. Where there's caution still on this yellow shirt I'm wearing is the long duration assets. And that is, from the equity perspective, still the growth play. That balance between inflation and growth, at least for a couple more quarters, is not compelling at all. What we did here in our chart of the Qs is we ran a regression. So the trend of growth of the NASDAQ, again, in the falling interest rate environment, it just got very accelerated. We're looking for a move back to the long-term trend. So we took that trend, pre-COVID, we extended it out. That projects into the range of the 61.8% for the Qs. And that's where it starts to get interesting for us. Not value, not deep value. That would be closer to 200 on the Qs. So this rally on the NASDAQ's an opportunity to take some money off the table if you haven't already. Not unlike what we were saying a few weeks ago when we had this pop towards the 200-day average. Have a great week, everyone.